As we approach the opening bell on this Friday, November 14, 2025, the picture for Beyond Meat, ticker BYND, is looking grim. The stock closed yesterday's session at $1.01, flat for the day, but the real story is happening right now in the pre-market. As of 9:15 a.m. Eastern Time, the stock is indicating a sharp move lower, trading at just $0.94 a share. That's a drop of more than 7% before the market has even opened, and it shatters a critical psychological and technical level. This isn't just another day of volatility. This move puts the stock firmly in penny stock territory and squarely in the crosshairs of a NASDAQ delisting notice, as the exchange requires stocks to maintain a minimum bid price of $1. The expectation for so long, fueled by one of the most explosive IPOs in recent memory, was that Beyond Meat was a technology company disrupting a multi-trillion-dollar food industry. The reality, as reflected by this $94 pre-market quote, is that the market now views it as a distressed asset, a low-margin food manufacturer fighting for its very survival. This immediate pressure isn't emerging from a vacuum. It is the market's continued, brutal reaction to the third quarter 2025 financial results that the company reported just a few days ago, on November 10th. That earnings report wasn't just a miss, it was a fundamental breakdown of the entire bull thesis. Net revenues for the quarter came in at $70.2 million. That sounds like a lot, but it was a staggering 13.3% decrease from the same period last year. In a market where investors were demanding exponential growth, Beyond Meat is delivering significant, double-digit decay. The volume of products sold fell 10.3%, and the net revenue per pound also decreased. This tells us a devastating story. They are selling less product, and they are making less on each product they do sell. This is the opposite of the scaling up narrative that the company was founded on. But the revenue slide is arguably not even the worst part. The net loss for the quarter was $110.7 million. This is a catastrophic widening of its losses compared to $26.6 million in the same quarter last year. Perhaps the most terrifying line item in that entire report was the $77.4 million non-cash impairment charge. When a company takes an impairment charge of that magnitude, it is, in plain English, management officially admitting to the market that their long-lived assets, their factories, their equipment, are not worth what they previously claimed they were. They have been impaired because the company no longer expects to generate the future cash flows from them that they once projected. This is a profound admission of failure and a signal that the long-term performance expectations have been permanently reduced. Gross margin collapsed to just 10.3% from 17.7% a year ago, and management's guidance for the fourth quarter was yet another warning, projecting revenues between $60 and $65 million, well below what analysts were already bracing for. This is the reality that is driving the stock below $1. The expectation of a high-tech, high-margin future has collided with the reality of a cash-incinerating business with shrinking demand. Now, I know what many of you are thinking, especially if you follow the chatter on X or Reddit, but didn't this stock just surge over 1,000% last month? Isn't this a huge short squeeze target? This is where the story gets complex and where we have to separate retail sentiment from financial gravity. Yes, in late October 2025, BYND stock experienced a mind-bending rally, a classic meme stock-style eruption that took it from its lows to a 52-week high of $7.69. That move, however, was not based on fundamentals. It was a technical event, a short squeeze triggered by a complex debt for equity swap. The company announced a tender offer to exchange $1.1 billion in convertible debt, which it had no realistic way of repaying in 2027, for a massive issuance of new shares. This single move created 316.2 million new shares, expanding the total shares outstanding by an in-your-face 502.6%. This was dilution on a scale that is rarely seen. The squeeze was likely a result of shorts covering, as the debt holders, who were also short, unwound their complex arbitrage positions. That rally was a one-time event, a technical anomaly. The 500% dilution, however, is permanent. The party from that squeeze is over, and what's left is the financial hangover. This brings us to the elephant in the room for Beyond Meat, the massive, and I mean massive, short position. This isn't just a handful of bears, this is an institutional consensus. As of the most recent data, the short interest as a percentage of the free float is sitting at an astronomical 36.64%. Nearly 4 out of every 5 public shares are being used to bet against the company. The raw number is around 65 million shares sold short, but it gets more intense. The days to cover, which measures how long it would take all shorts to buy back their shares based on average volume, is over 14 days. This is an incredibly long time and points to an extremely crowded trade, creating a powder keg for volatility. Furthermore, the short borrow rate fee, the cost to borrow shares to short, is sitting at a punishing 26.62%. This isn't a cheap bet. Shorters are paying a high price to maintain their positions, which tells you how convicted they are in their thesis. So, what is the short thesis? It's not just a vague bet on manipulation, as some social media forums might suggest. The bear case is clear, and it's based on the earnings report we just discussed. First, the cash burn. The company is losing over $110 million in a single quarter. With its current cash on hand, this rate of burn is not sustainable and points towards insolvency. Second, the collapse in gross margins. The company has no pricing power and the cost to produce its pea protein products remains stubbornly high. Third, the demand has peaked. The data shows U.S. demand for animal meat is at multi-decade highs, while the plant-based category, which Beyond Meat itself created, is shrinking. Competitors, from Impossible Foods to private label grocery store brands, have eaten away at what little market is left. Firms like D.E. Shaw and Wolverine Asset Management have been reported as holding large positions, and while their full strategy involves complex options, it's clear the smart money is positioned for a further decline. What's your take on this massive short position? Is it smart money seeing the inevitable, or is it predatory pressure? For investors trying to navigate this, here is the actionable insight. You can track this data yourself. You can look up short interest on platforms like Fintel or Ortex, or often directly through your broker. When you see a high borrow rate like 26%, it means demand to short is high, but it also puts pressure on shorts to close out their positions. When you see a high days to cover, like 14, it means any positive news could, in theory, cause a violent squeeze as they all rush for the exit. The danger is in assuming a squeeze is guaranteed. In this case, the fundamentals are so dire that the shorts are willing to pay the 26% fee because they believe the stock is on a path to zero. Chasing a squeeze in a company that just told you its business is shrinking and its assets are impaired is not investing, it's gambling on a very low probability outcome, especially after the 500% dilution. The risk of a reverse stock split or a bankruptcy filing is, at this point, far higher than the risk of a sustained squeeze back to $7. For anyone who is just tuning into this story, Beyond Meat's business was built on the idea of creating plant-based meat substitutes, primarily from pea protein, that look, cook, and taste like real meat. Their flagship products, the Beyond Burger and Beyond Sausage, were placed in the meat aisles of grocery stores and featured in high-profile food service partnerships like the McPlant at McDonald's, which largely failed to gain traction. The expectation was that, as they scaled production, cost would come down, margins would expand, and consumers would switch en masse. The reality has been the precise opposite. Costs remain high, consumers are proving to be price-sensitive and are pulling back from the category, and the plant-based novelty has worn off, leaving Beyond Meat to compete in the brutal, low-margin packaged foods industry, a battle it is currently losing. So, what is the future outlook? Where does this go from here? The path forward is incredibly narrow. Management is talking about cost-cutting and a transformation, but their own fourth-quarter guidance projects even lower revenues. The analyst community has all but abandoned the stock. Just yesterday, Mizuho slashed its price target from $1.50 down to $1, maintaining its underperform rating. Other analyst ratings are a sea of sell and strong sell. The consensus is that the business is broken. The most immediate catalyst to watch, as I mentioned, is the NASDAQ delisting process. If BYND closes below $1 for 30 consecutive business days, it will receive a deficiency notice. This would force the company into a desperate move, most likely a reverse stock split, a mechanism where, for example, 20 shares are consolidated into one. This artificially boosts the share price back over $1, but it does nothing to fix the underlying business and is almost universally a sign of a failing company. The bull case scenario at this point is almost non-existent. It would require a sudden, miraculous turnaround in consumer demand for plant-based meat and a simultaneous massive reduction in their cost of goods. A buyout is also unlikely. What major food company would want to acquire a business that is burning over $100 million a quarter, has shrinking sales, and just wrote down its own assets? The bear case is much clearer. Continued cash burn, a delisting notice, a reverse split, and an eventual filing for bankruptcy protection when the cash runs out. Let me know in the comments, do you see any path to survival for Beyond?